Thank you, Chairman Scott. Chairman Powell, welcome. Thank you very much. I think your monetary policy combined with the Biden fiscal policy over the last 4 years has made a tremendous difference. We've avoided a recession. And I'd like to remind people how far we've come. In 2020, the gross domestic product decreased 2.2%. The unemployment rate finished the year at 6.7%. By 2024, gross domestic product grew 2.5%. The unemployment rate was 4.1%. Labor force participation rate went up from 61% to 62.5%. And that's a combination of your work together with the fiscal policy of the Biden administration. So I thank you for that. One of the issues before us today is the issue of tariffs. In July 2018 testimony, you stated, Mr. Chairman, countries that have remained open to trade, that have not erected barriers, including tariffs, have grown faster and had higher incomes. Do you still believe that?
Yes, I do. I would stand by that.
So President Trump's tariffs on China, Canada, and Mexico will obviously raise costs on families. In fact, some economists, many economists, project about $1,200 per year households will be paying extra. An increase of inflation by nearly 1%, economic growth depression, and, for example, the increase of the average car price by $2,700. Is that a wise policy?
So I guess I ought to say this. I think the standard case for free trade and all that logically still makes sense. It didn't work that well when we have one very large country that doesn't really play by the rules. And in any case, it's not the Fed's job to make or comment on tariff policy. We, really, that's for elected people, and it's not for us to comment. Ours is to try to react to it in a thoughtful, sensible way and make monetary policy so that we can achieve our mandate.
Just this weekend, the president removed the board of the Kennedy Center and made himself chairman. What would you do if the president tried to remove a member of the Federal Reserve Board?
Well, it's pretty clearly not allowed under the law.
Thank you. We've communicated back and forth about synthetic risk transfer as a potential danger to the banking system. And could you give us some insights on how we can improve financial stability by regulating these transactions more appropriately?
So what we've been doing for some time now is looking at them on a case-by-case basis. And if they really do transfer risk successfully, then that's okay. I mean, it's a good thing if a bank wants to transfer risk off its balance sheet in a way that it gets compensated for and all that. But what you want to make sure is that the risk is really transferred, and that was the problem during the global financial crisis, was sort of things that appeared to but did not accomplish a transfer of risk. So we see this coming, and we've been looking at these transactions on an ongoing basis.
Well, I commend you for that. In fact, what happens typically is the transaction becomes complicated by synthetic risk transfers, as it was the case with synthetic derivatives. So thank you for your attention to that. We've talked about housing. It's absolutely critical everywhere across the country. We're in a housing shortage. Affordable housing is difficult. Two of the mainstays of our housing market are Fannie Mae and Freddie Mac, helping to support home ownership. Does the federal guarantee backing Fannie and Freddie help make mortgage rates more affordable and home ownership more accessible, Mr. Chairman?
I imagine it does hold down mortgage rates, the fact that they're a sovereign risk.
And how important is the 30-year mortgage to ensure that families can afford a home?
In our housing market, the 30-year mortgage is very important.
Yeah. And I have heard some discussions about eliminating Fannie Mae and Freddie Mac, which would be detrimental, I presume, to the housing market.
That's really a question for you. I mean, putting them back in the private, putting housing finance back in the private sector has some appeal over the longer run, but I leave that with you.
Thank you, Mr. Chairman, very much. Appreciate it.